We are about to start our last housing market town hall for 2022. As usual, we're going to start with our housing market update. But first, let's start with some updated news with our YouTube channel. If you follow us on our YouTube channel, you'll notice that we have been adding a lot more different type of videos on there. So I hope that you will subscribe so you can get notification whenever we have a new videos. Let's go ahead and get started on the Bay Area housing market stats. There are a lot of information I want to share. First, somebody had asked me if we can add San Francisco County onto our statistics and analysis, and absolutely, and thank you so much for the feedback. And that's why I'm here. From this point on, you'll see that I'm adding San Francisco County as well. So now we have 5 counties that we are keeping track on. And this is the months of inventory. We want to see how the market's doing. As you see that in the beginning of the year, the first 5 months, or I should say first 6 months, but less than 2 months of inventory. And then we kind of went up to 2.3 months of inventory in July. And we kind of went down to 1.8 around August and went back up in October. Right now, we came back down 2 months of inventory. Again, we've mentioned this before. It's still not bad because like a normal months of inventory should be 4 to 6 months. Just for example, when I just started in this real estate market about 2005, I think our market at the time was about 2 months as well. But then in 2008 to 2012, that was over 6 months of inventory. So it was very normal for us to just kind of like wait around for our listings to be sold instead of just selling them within a week or 2 weeks. So right now we kind of like back to a normal time frame. A lot of our listings that we see will stay on the market about 30 to 60 days. Okay, so now what about the days on the market versus the sell over list price ratio? So let's take a look at days on the market for these 5 counties. We are kind of like just staying around almost close to 3 weeks right now on average for 5 counties. We do see that some of the area with very good school district, very close to employment centers, for example, these tech companies, they are still moving really fast, especially if they have their good school district. We still see multiple offers for those type of properties. But then we do have other type of properties that are staying on the market for, like I said, 30 days to 60 days if they don't really have this extraordinary location and homes, right? Everything's done up. So it averaged back out to about 3 weeks still. But then in terms of like the sales price over list price, as you see, it has gone from 14% all the way down to 100.4%. Even though I mentioned there are multiple offers, but still the multiple offers is really conservative right now. People are not willing to pay above and beyond. And most of the offers out there, they actually offer below asking price. So this is really important to understand because it also helps with how to price your property. Believe it or not, there are still realtors suggesting sellers to list their property at a very low price. That strategies work in some of these areas that I mentioned that have really good school district, everything. This house is just perfect floor plan and everything. But in terms of if your house doesn't have all of those factors, then you should probably price it a little bit higher because, like I said, most of the buyers nowadays coming in, they still make offers slightly below asking price. And in terms of how many number of listings withdrawn and canceled, we tracked it because, of course, during around the month of May and June, it just shot up so much. The market kind of like it's not even like slow. The market literally felt like it just paused. It went back to 2020 in May, actually not May, but around March and April. Although the market is open, but there was no buyers anywhere. Buyers just not looking at that time. So you can see that at the time around May and June, there were just these huge numbers of listings being withdrawn or canceled. But then the numbers is starting to come back down and they are kind of normalizing. So the number of listings, they don't have as many withdrawn and canceled. The sellers who are on the market, they now finally understand, hey, the market has been volatile. If they are ready to put it on the market, they understand that they're not really going to be able to get the price that they were hoping back in May or June. So we don't see as much withdrawn and canceled anymore. And in terms of the list price decrease, in Santa Clara County, we do see it topped in August that the price was just decreasing. And then it started to taper down to November, only 392 versus 688 listings that had list price decreased. And in San Mateo County, we topped at 200, actually 300, and they came down to 222 listings that has price decrease. And Alameda County, it went up to 792, almost 800 listings that had price decrease, and now it came down to only 510. And San Francisco, we had topping at 457, which was just October and November. It came down 275 listings. And Contra Costa, it topped in August, 910 listings, and now it came down to 565. So it's interesting, right? Like now you see that a lot of these, a lot less listings in these counties have price decrease compared to the previous months. So one of the reasons is probably because a lot of sellers kind of set a better expectation in terms of the asking price. We noticed that a lot of sellers were still trying to ask like really high price, and then realizing that, hey, it's not moving, then they finally have to lower it. But by the end of the year, a lot of sellers do have to get it sold within this year, ideally by end of the year. So that's why a lot of them is just like, you know what, we're gonna just go in with a lower asking price. Hopefully we can gain some interest quickly, and then we can close by year end. All right, and how many transactions fell through? The reason why we're looking at this is because obviously mortgages have been a challenge nowadays. We do see a lot more contingencies. People actually put inspection contingency, loan contingencies. And that's also another reason why we see some sellers, they would prefer to take a lower offer, but they would like to take a cash offer because then there's not as much uncertainty with their loan. So that's what we noticed for a few of our transactions, that the sellers would take relatively much lower price compared to a financed offer by like $50,000 or more, just so that they can have a peace of mind and just close the deal. So when I kind of did both, it's like 4 counties because I wanted to compare. I redid all the numbers starting in January by adding the San Francisco County in here. So you can see that the difference is about like 20%. In terms of the number of transactions fell through. And in November, we actually have dropped quite a bit to only 134 deals that were transactions fell through for all 5 counties. And honestly, 134 is really not that much. If you look back to beginning of the year, March or April, we're around the same numbers over that time. So really 134, this number is actually pretty good for all 5 counties. All right, of course, everybody want to know is that what happened with the price, right? So now here we track all these median sales price for all 5 counties, and these are all for single family pricing. Now, Santa Clara County, like the purple area, these are the highest during this whole pricing kept going up, and then it started coming down. So as you see, the Santa Clara County peaked in April for $1.95 million. And we had a full month of November, came down to 1.572. And as of today, the median sales price 1.478 for Santa Clara County. As for San Mateo County, peaked in April at $2.25 million. And as of November full month is 1.705. But as of today is at $1.65 million in terms of the median sales price. For Alameda County, it actually peaked in the month of May, so at $1.5 million. And as of November, it was 1.158. And then as of today, it's $1.061 million for Alameda County. Now, as for San Francisco County, we peaked in April at 2.05, and November full month at 1.5. And it's interesting for San Francisco County, actually, the price had gone up a little bit as of today at $1.525 million. But the price adjusts a little bit. I do see about maybe $50,000 plus or minus in terms of like when I do a half month versus the full month. There's going to be some adjustment there, but it's not going to be huge. At least right now we see it, unless there's this one big deal that happened in the county. But it looks like it has gone up. So we'll see next month when I do a full month of December, and let's see that if 1.525 is truly the number. And Contra Costa County in May, it peaked at $980,000. And as of November 30th, full month of November, it had come down to $855,000. And as of today, it's $810,000. So what does that mean? So we kind of look at the month-to-month percentages. Santa Clara County came down 0.91% compared to last month. And year over year came down about 11.86%. But if you look at from the year over year is like comparing from last year, December to this year pricing. But if you look at from the peak number, which was like peaked in around April and May, then it had dropped quite a bit, about 24%. And this is for San Mateo County, month to month, it's a drop of 5.28%, year over year, 8.33%. But then from the peak, it had dropped 20.67%. And Alameda County, month over month, is 3.5% price drop. And year over year is about 9.32% price drop. But then coming down from the peak is about 28.31%. It's almost 30%. I know some of you probably like, oh my gosh, if I have closed escrow around April and May, I know it's tough. As long as you are, like I always say, if you're living in your house, in your property for long term, 5 to 7 years, don't sweat it. You got this amazing interest rate, right? A lot of people who are buying right now wish that they have that kind of interest rate. So you are still winning in that sense. But understand it looks really bad right now by looking at these numbers. So I just want to allowing you guys to see the positive side of it is that you got to enjoy this very low interest rate, and it's going to take some time for us to get there. San Francisco County month-to-month percentages, it came down 10.18%, and year over year it came down 10.29%. The price drop from peak is actually 0.61%. And now Contra Costa County month to month actually went up 1.79%, went up a little bit. But it dropped about 1.82% year over year, which is really little. It's not much at all. And it dropped the least is from the peak is at 17.35%. So I thought this is interesting to actually now like recapping. We are in December, just kind of look back to see how bad it has been. I know everybody's kind of really worried. It's like the market's changed, completely shifted from like this high to it's really low. So right now we do see, I would say like right now looking at this on average about 25% drop across the counties. Do I think that this is the right time to buy? I still think that the price probably going to drop a little bit more next year in the beginning. And I'm going to go into a little bit more of the macroeconomics of this as well. So you guys can take a look at what you think the market is going to be like next year. And this is by Lawrence Yun. Lawrence Yun actually says that the upcoming months should see a return of buyers as mortgage rates appear to have already peaked and have been coming down since mid-November. Some of you might notice, I know we did see a couple price drop. Hopefully Sean will be able to come in and then share that information as well regarding the mortgage rates. But we ourselves, among our own clientele, we do hear a lot more about, oh, we're going to pause right now and we're going to come back next year to take a look at the market, see where it is. So we do expect more buyers to come back, but it doesn't mean that the price is going to come back up just because the psychology is so different now. They're going to come back, but then they're just going to probably make offers, very, very conservative offer until we start seeing the mortgage rate start to come down. Then you're going to see really a lot more buyers going to come back up and to buy. But there are so many other factors that can affect the market, and we are going to go into it in a little bit to talk about that as well. All right, so these are some of the battleground we have for November, December. Definitely slower months, but we had a few under asking price. A few people are offering, but they're all under asking price. For example, in the San Jose, Willow Glen area, it ranges from $1.2 million to almost $3 million, but they all pretty much came in under asking price. San Francisco area asking at 1.575 and had not 5 offers, but went to 1.6 million dollar, and then it fell through. But then they got another offer at 1.8 million dollars. I mean, it sounds interesting, right? Because how come they had multiple offers originally, went under contract at 1.6, and then all of a sudden they got another offer at 1.8 million dollars? I do have to say that's something you have to be careful on what kind of agent you're using to make sure that they understand the market, how the market is, and how the psychology of other buyers are right now. All right, so the last one, San Francisco, 1.395 asking price, got 5, still a bunch of low ball offers, but you just need to take one person to be willing to offer over asking price. And now they had a $1.6 million accepted price for that listing. So, and then the bottom here, we kind of share a little bit about our own experience with our buyers. We were able to negotiate price $300,000, almost $300,000 below asking price on one of the properties that we knew during the peak would have been crazy, maybe 300,000 over asking price. But it does have one flaw on this property, is that it's on the busiest street. So they had a lot of interest, but they didn't really have a lot of strong offers. So we were able to negotiate. And then we also, for a few buyers now, that we were able to negotiate some credits during escrow due to a lot of different reasons, just because like nowadays we do have more contingencies on our offers. So after inspection contingencies, sometimes buyers just feel like, okay, I feel like I need to renegotiate. Or we had a situation where the loan almost couldn't close. So we had to negotiate some credits back in order to close the deal. So these are some of the situations where we were able to actually negotiate for our clients. And then lastly, there's a client that we negotiated, and when we got the appraisal, it came back $100,000 over our offer price. So it was really awesome knowing that they already have that equity right off the bat. Now, what about the multifamily market? We're looking at multifamily, industrial, and office. These are kind of like 3 sectors that a lot of commercial realtors or investors are looking at right now. And I have to say, multifamily is still the winner, even though in this slow market. The only difference is that we do have less buyers right now, mainly because the interest rate has gone up so much. So it makes it a little bit more worrisome for them. But multifamily is still a very strong sector in the commercial real estate. So let's take a look at this report from CoStar. This is for San Francisco multifamily side. And as you see, the cap rate, year-to-date cap rate is still at 3.5%. If you understand cap rate and interest rate, you get a cap rate at 3.5%, and while your mortgage rate is at 6%, you're not going to cash flow. And even if you put 50% down payment, you still can't get cash flow on these properties. And it's just amazing to know that they are still getting 3.5% cap during this kind of slow market. As for San Jose, same thing. They are actually at 4% cap rate, average cap rate. And the trend is that it's still thinking that it's going to stay right around 3.5%, mainly because a lot of times sellers are still not willing to come down on their selling price. They still see that there are a lot of the rental potential on the market. And so we definitely have this huge discrepancy between the seller's expectation and the buyer's expectation. So the market is slowed down quite a bit in 2022 for the multifamily market, but at the same time, the cap rate is still staying really, really strong. As for East Bay multifamily, the average cap rate is about 5%, which is a little bit higher, and it's very common to see that East Bay cap rate is a little bit higher than San Francisco and also San Jose. But then they are trending, or they're expecting the cap rate is going to stay at around 4.1% or so. So this is, I thought, is really interesting to see when the interest rate for the multifamily side is at about 6% or more, but their cap rate is so much lower compared to the mortgage rates, and it didn't get adjusted drastically compared to how much the mortgage rates have gone up. So let's talk a little bit more macroeconomic side. In 2022, we have a lot of hot topics this year, including the Fed fund rate increases, inflation, Ukrainian war, unemployment rates, tech layoffs, which we are going to talk about, and supply chain issues. And in the last year, during our webinars, I pretty much had talked on pretty much all of these topics besides the tech layoffs, because it just started to happen towards the end of the year, right? Like the fourth quarter. So let's talk about the Fed fund rate today. Today is the December 14th, and they just raised rate by 0.5%. It's a lot, but at the same time, good news is that everyone was expecting they're going to raise rate by 75 basis points. until the inflation rate had came out was lower than expected. So they decided that it was like 0.5% is already good enough. They don't have to increase by 0.75%. So I thought that is a really good indication that we are slowing down on increasing the Fed funds rate. Right now, the outlook is that they're going to raise it to about 5.1%. So I think probably in the beginning of the year, they're going to do a couple more rate raises, and then that's it. And then the rate is probably going to stay pretty much constant. Now, in terms of inflation rate, as we mentioned, the inflation rate has been pretty high. Starting January, 7.5, all the way peaked at 9.1 in June. And now it came back down to 7.1. Is not great numbers yet, but at least it is going into the right direction at least. Now, in terms of unemployment rate, I know this is a lot of concern for the unemployment in our area. So in the San Jose South Bay area, the statistics is that, okay, let's look back in 2017. The unemployment rate is at 3.3%, 2018 2.7%, and 2019 is 2.6%. And of course, 2020 went up to 7.3, came back down to 4.8, and as of 2022, October is at about 2.2%. But I thought it will be interesting to kind of also look at the labor force. We had about 1,068,000 people in the labor force, and now we have about 1,093,000 people in the labor force. So we definitely have more people in the labor force, and the unemployment in terms of the number of people, as you see here, is actually lower than 2017 numbers. So I just thought to point that out. So we can, besides looking at the rate, we can also look at the number of people that they are accounting for. And in terms of San Francisco, Redwood City, so more the peninsula area, and look at 2017, the unemployment rate is at 2.9%, 2018 at 2.3%, and 2019 at 2.2%. And then 2020 at 7.6, 2021 at 4.8, and then in 2022 it came back down to 2.1. Same thing, they have quite a bit more people in the labor force, but at the same time, the unemployment number of people has come down quite a bit from 28,786 to 21,406 people. Now, what about on the other side, more like the East Bay, kind of like San Francisco, Oakland, and Hayward area? For 2017, they had 3.4% on the unemployment rate, 2018, 2.8%, 2019, 2.7%, and 2020 at 8.3%, 2021 at 5.6%, and 2022 right now is about 2.6%. And however, the labor force for this side is staying around the same. It doesn't have the increase we saw in the San Jose area and also the San Francisco Peninsula area. And in terms of number of employment, though, it still also has a lot, actually less people compared to the past 5 years. So I know, but then we still have this concern, because we have all these tech layoffs, right? We talk about Airtable, Amazon, HP, Cisco, Asana, Amazon, Zendesk, Salesforce, Twitter, and Apple, and of course Meta. And Meta also has spent $36 billion on this metaverse, but it just seems like it's not really catching on. This is actually a really interesting thing. I kept thinking metaverse is supposedly the thing, right? Like this virtual world. I myself am not crazy about it. I just cannot imagine us wearing these goggles and just going to meetings in our avatar or whatever, and communicate and network with people. I know it definitely is going to be something, but I do hope that my kids not going to be living in this metaverse. I hope they will be living in the real world still. So I don't know. I have this mixed feeling about metaverse. Really scared. I think it's really scary. At the same time, I know it's going to happen. I just hope that our kids, all I can think of is about my kids. Like, I just hope that they're not going to be hooked into that and live in this virtual world. But anyhow, so let's look at the foreclosure activities as well. Okay. Now, foreclosure activities, we've been talking about this. I know there are a lot of reports talking about, oh my God, the foreclosures have gone up by 50% or 100%. So let's look at the numbers. If we look at 2008, the foreclosure activities from January to June filings, 2008, during the last mortgage recession, those are all over a million foreclosure activities. And right now in 2022, first half, we had about 164,000 foreclosure activities. And in terms of like, here's some news article from Adam team, and US foreclosure completions increased annually by 64% in November 2022. So again, I just want to show is like, we do see a lot of these articles right now talking about how foreclosure activity is peaking. While foreclosure starts and foreclosure completions both increased compared to last year's artificially low levels, they declined from last month. And lenders often put a moratorium on foreclosure during the holiday season. So why does they say artificially low levels? Is mainly because the foreclosure, there are a foreclosure moratorium last year still. So that's why it was basically being really, they just didn't start that foreclosure process, right? So that's the reason why the numbers were really low last year. Those major metropolitan areas with a population greater than 1 million had the greatest number of foreclosure starts in November 2022, including New York, Chicago, Houston, Miami, and Los Angeles. All right, here is super small. I know you probably cannot see, but I try to highlight all the California cities. So this chart is showing the green bars is showing that properties, how many properties are in terms of percentage have less than 10% equity. So, and then in the blue bar, meaning that they actually have negative equity. So the total of all that, meaning that they all have less than 10% equity. So if you look at Riverside, Bakersfield, San Diego, Stockton, and Sacramento, they are ranging quite high. So these are all about like over 50%, and Bakersfield is over 60% have less than 10% equity, and they have about 20+% in terms of negative equity. But if you go towards, so there are also Oxnard, Fresno, and if you look at San Francisco, so this is San Francisco, a little over 20% of the properties have less than 10% equity, and about maybe, I think this looks like about 5% that have negative equity. And then Los Angeles here, Los Angeles looks like it has less than 20%, probably about 18% that have less than 10% equity. And out of that, about, I don't know the numbers, I'm just eyeballing it, it's probably about 3% that's have negative equity. And then San Jose is all the way down here. It looks like maybe 1 or 2% or 1% that has less negative equity, and has less than 20% that has less than 10% equity. So I thought this is important to look at, because if we are worried about foreclosure activities, we definitely need to look at the statistic, whether how much equity these properties have. And as you see that a lot of times these area, Riverside, Bakersfield, Stockton, or Sacramento, they probably have a little bit more people use FHA finance, right, or VA finance, and they only require 3% down and 0% down. That means that they will have a lot less equity on the property. While versus like in San Jose area, a lot of people have to use 20% down conventional financing in order to buy the property. So that's why they have a lot less people have negative equity on their property. And then in terms of the foreclosure numbers, if we look at compare, 2008 to 2012, where they had $4 to $6 million non-current loans, compared to in January of 2020, we had 1.95 million. And also 2021, they had about 3.3 million, versus right now in October, we have 1.7 million, which is even less than in year 2005. These are everything, not just foreclosure, but including all the non-current loans, meaning they're not current on their payment. All right, so in summary, Fed fund rates increase will slow in 2023. And the inflation rate is moving towards the right direction. So that's why the Fed fund rate is probably going to slow down in terms of the increases. We don't know if the Ukrainian war is going to continue, when it's going to stop, unfortunately. So we've been actually praying every single night that we hope the Ukrainian war is going to stop one day. The unemployment rates most likely is going to continue to increase. Tech layoffs will continue, unfortunately. And the supply chain issues is still going to last for a while, because even though China just opened back up a little bit more due to their zero COVID restriction, but still there are a lot of supply chain issues that's still going to happen, and that trickled into our consumer products. So that is still going to be some issues there. So I cannot tell you whether next year is going to be a great year or not. I know there's still a lot of negativity about next year, uncertainty about the economy. I feel that way too. But, in terms of me being on the ground, watching how our buyers are responding to the economy, we just know that there are still a lot of buyers. There's still a lot of demand, but they're just really watching how the market is going to go. And also, in San Jose, in North San Jose, they just approved these 36,000 units housing. So that's going to be a huge pump of housing supply onto the market in San Jose area. Downtown San Jose, they still have all these developments going on with offices. Offices is one asset type that I'm really worried about. But the smaller offices seems to be moving. But if you have a bigger office building, that's when it's a little bit tough to move right now. Thank you everyone for joining, and happy holidays. I guess we'll see you guys next year then. Bye.